analysts are talking about, people on the news are talking about this giant recession, but you not giant recession, but it feels recessionary.
You heard it here first.
Giant recession, giant crash coming. But it feels that way. But you, like, to your point, John, you look at the market and, like, no one's really doing anything. It's almost like it's priced in that it's not going to happen.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. This is Matt Walters here with John Martfeld.
Good morning.
And Isaac Johnson.
Hello.
And we're excited to be here. So today we want to talk about a few things. GDP numbers came out not long ago. We want to touch on that. Our expectation for what the Fed's going to do for between now and the end of the year, and we're going to talk a little bit about Berkshire. So, John, you've got some interesting data and kind of some thoughts on GDP numbers, where we're at, what we just saw, the print come out at.
The print came out. GDP was negative 0.3% for the first quarter. Right. So, first quarter that we've had a drop, a negative since 2022, which you have to have 2 quarters in a row, to signal a recession. Right, we've talked about that a couple of times because like anybody can say recession whenever, so people think we're in it now. But the main reason for this was that trade with other countries accounted for the largest drag on the economy for any quarter since 1947, and it says at least 1947. In other words, the data doesn't go before that.
Mm-hmm. Yeah.
So it's probably been well before that. So in other words, even though it was a drop of negative 0.3%. You have to take into account what this is going on with the tariffs and the trade talk. And when you look at that and say, okay, trade with other countries accounted for the largest drag on the economy since at least 1947, gives me a little hope, right, that we may not have that second quarter of negative GDP if we can get some of this trade stuff through the system and the tariff stuff can get down. So anyway, when you first hear the number, markets sold a little bit on that news, and then it kind of stopped, it kind of dissipated. Now we're actually just kind of neutral since those numbers came out. I think if you thought we were having a full-blown recessionary crisis, I think the market would be falling, or at least in the short term. But anyway,
what's going to be super funny is Biden during Biden's administration, that we had 2 negative quarters of GDP, right? And everybody, there was the argument of like, well, is it a technical recession or is it
right?
And it wasn't ever classified as a technical recession, but a lot of people said, well, this is how we've always kind of defined it, or historically have defined it, as 2 negative quarters of GDP.
Right.
It'll be funny because we're going to flip-flop that, and if it happens under Trump, all the people that were saying it wasn't a recession are going to be saying, like, well, as soon as we print 2 negative GDP quarters, and then all the people that were saying it was a recession last time are going to be like, no, it's not a recession. So welcome to America.
Exactly. In this hyper, political environment. Real inflation-adjusted consumer spending increased at a 1.8% annual rate in the first quarter, and real business investment in equipment spiked at a 22.5% annual rate, neither of which look recessionary. Right? Those are positive numbers. So you have to dig deep into this.
Sure.
There is opportunity to create, but to your point, the political side of this is going to be kind of funny to see.
That main GDP print, just like it was last time, of like as soon as we saw it, we're like, we're in a recession. It's going to be the same this time, just from different people.
By the way, if you took core GDP, which excludes government purchase, inventories, and international trade, the most important piece of this, grew at a 3% annual rate in quarter one. I'll stop giving you stats on GDP.
That's right.
But it's just interesting to see all these things play out.
What's weird is, like, there's almost a disconnect. I was listening to another podcast this morning talk about it, between what analysts are talking about, people on the news are talking about this giant recession, but you not giant recession, but it feels recessionary.
You heard it here first.
Giant recession, giant crash coming. But it feels that way. But to your point, John, you look at the market and, like, no one's really doing anything. It's almost like it's priced in that it's not going to happen, even though I don't know what the stats are. It feels like every month they change it to like 40% chance. 45% chance.
I know.
This is my scary part about the potential for recession, because all this stuff, you're right. We keep pushing it, kicking it down the path, because I've heard recession talk. I have been the bear on this podcast for a long time. I'm not a bear. I'm a bull. But anyway, people like to think of me as a bear on the podcast. All right. This is the stuff that does scare me, though. All right. Federal the federal budget. So both in 2023 and 2024, we saw the most reckless spending in our lifetime, with a budget deficit running in the range of 6 to 6.5% of GDP. Even the unemployment rate, even though the unemployment rate hovered around 4%, to put that in perspective, the highest deficit under President Reagan was 5.9% of GDP when the unemployment rate was 10%. The reckless deficit expansion of the past 2 years likely masked or hid some of the pain we were eventually going to feel from the tightening of monetary policy. So, there's still stuff out there that we've done that we haven't accounted for or paid the price for. And that's what scares me a year from now.
Let's stop talking about it.
I know. So there's good news and bad news with every report. I guess that's the point.
Well, talking about, a couple years from now or a year from now, we wanted to touch on kind of what we think the Fed, the Federal Reserve should do or will do between now and the end of the year. And so here's my thoughts, and then y'all can give your thoughts that no one cares about. But I'm just kidding. But we went for such a long time. No, you have like a raving fan base from this podcast. So everyone's just on pins and needles to hear your
right.
We went for such a long period of time with such low rates, right?
Yeah.
They took rates higher for all of the reasons they needed to. The longer we stay at an elevated level, which I know, and I've been on here saying hey, historically, rates aren't high. We're at a kind of normal-ish range.
Right.
But I think the one thing we have to be aware of is we're coming off of a historically low rate environment.
Yeah.
And so it feels really high. And it's not only going to feel really high, it's going to become real in a lot of ways as debt starts rolling off and having to get refinanced.
Exactly.
And the longer we go at higher rates relative to where we were during the the 2010s, 2010 to 2020,
right,
the harder that's going to be as that debt starts to roll up and need to get refinanced.
Yes.
And so for that reason alone, I think the Federal Reserve does need to bring rates down, because I think there's going to be some shocks that start to hit, whether it's specific businesses, specific industries, whatever. It's going to start, being felt more and more the longer those rates stay where they're at.
Yeah. Well, and a lot of loans, at least my background's a little bit more into real estate, but these commercial loans, they're not locked in for 30 years like a residential loan is, and most of them are on these 5-year terms.
7 years.
5 or 7. So we're creeping up on refinance time for a ton of business.
Right. Yeah. No. And exactly. And I think it's helped because it's only been the last couple years.
Yeah.
We haven't felt that because a lot of people, companies, individuals, went into this in a really good spot. Yeah. They strengthened their balance sheets. They had borrowed debt while it was low. They've got low mortgages. But that's less and less true the longer we are at 6.5%, 7% mortgages, and these small businesses we were talking about it just a little bit ago. Small businesses, it's not uncommon for you to have to go borrow at 10 to 12% right now.
Right.
If you don't have a lot of options and you're having to go to the private credit market or and that might be
tough.
Doable for a period of time, but it's probably not sustainable over the long term.
What do you think needs to happen for a rate cut to come? I don't know. We're probably not getting one.
I think we're going to get one in June.
I think we need two more tweets from Trump, and that'll do it.
It'll do it. I think if he calls Powell a loser one more time, it'll really get to him.
You think about this going back to the recession of 2008, the financial crisis. That actually started well before 2008, right? The markets just felt the brunt of it in 2008.
2005, 2006.
Yeah, 2005. We knew we were extended. People were into dead up to their eyeballs.
Yep.
There was a commercial back then. You guys don't remember this because you were little puppies.
Sure.
But there was a commercial back then, and a guy on his lawnmower, and he had this beautiful lawn, and he was talking about how showed a picture of his pool and his big cars and his boat and his house, and he's mowing the lawn. He's like, "How did I do it? I'm in debt up to my eyeballs." And it was a commercial about how you could get 125% of your home value on a second mortgage or a line of credit. And that was pushed.
125%.
And this was 2006 and 2007. And they were showing this. It's like anybody with a brain knows that is not sustainable.
Yeah.
Just like in the last 2 years, the debt that we have been overly borrowing. So think about when you've got 0% debt or 1% or whatever, and you borrow money on 1% debt for a long time. It doesn't really hurt you because you're paying back 1%. And our government has been victim of doing that big time, right? Using that
Sure.
that 1% credit card, and they've just been extending, and the spending has not stopped. That's the problem. Spending has not stopped as rates have gone up. So there comes a point where those two things come to head. We haven't really had that happen yet, but it is coming. So I think it is just for that reason. I hope the Fed lowers rates just for that.
I'm not saying they need to go get us back. They don't need to go get us back to where we were.
Right.
No.
But somewhere in the middle, I mean, I think dropping rates, 50 to 100 basis points over the not too long term, was probably
would feel good.
Probably needed for a lot of people.
So think of it.
Businesses.
If they do that this year, and if the tariffs get kind of settled, and if the tax bill, the Trump tax cuts get extended or permanent or whatever, this market has a lot. Like the economy has a lot of room to run.
Yes,
if we go check, but. It may be hard getting check, right?
Yeah.
I mean, well, that's the hope anyway that we do that.
Yeah. So I expect them to cut.
I do too.
think they will do something, and I think that is the right thing to do.
I think if they don't
cut
in June,
a few times.
I think the market will not like that.
Right.
I think we're kind of like
Agreed.
almost pricing that in.
It feels like it's priced in.
Yeah, I think so too.
Yeah, agreed. And then we wanted to touch real quick on Berkshire with Warren Buffett just announced, he's stepping down at the end of the year. Abel, is going to step up and be CEO, which that's been known for a while, but this is just the news of like the timing of exactly when it's going to happen. Berkshire opened up Monday. It was down 4 or 5% for the day. It's trading at or near all-time highs, so not a huge deal. But but yeah, I mean, Warren Buffett, he is kind of like the legend of all legends.
Absolutely.
When it comes to investing.
And you said something off air you probably don't want to say.
I'll say it right now. Berkshire B is the most confusing, or just Berkshire period is the most confusing
so we were
stock
looking
I've
at
ever
this
seen.
the other day, and this is we're not.
I know it off the top of my
haters,
head.
okay?
I'm not. I love Warren Buffett. Value investing is incredible. Get your McDonald's breakfast with the Diet Coke every morning. I'm all for it. But it was year to date a couple days ago when I was looking at it. It was up 17 or 18%. Every underlying holding except for one was down on the year. And I was like, that doesn't make a ton of sense.
Yeah.
Digging into the picture, they also have like $330 billion of cash, essentially.
Yeah, they created cash recently.
So, yeah.
A lot of cash, And they say that's for the transition.
Right.
But a lot of people speculate that's because Warren Buffett has this crystal ball and thinks there's something bad happening.
Yeah. I also think Warren Buffett's he's been around for a while. A couple years, and if you give him a treasury at 5%, like he knows that's pretty solid, and he's going to take advantage of it, and so that's what the only thing I could really kind of come up with is that cash holding was giving people a sense of safety with the volatility going on and just flooding into it.
So Warren Buffett goes back to the 80s, right? And his whole theme was buy and hold, right?
Yes.
Don't be a day trader. Don't try to time markets. Buy and hold, right? Find stuff you love, buy and hold.
Yeah.
And it's easier to do that when you're a billionaire, by the way. It's much easier.
Yeah.
It's kind of like, I love Dave Ramsey and I've read his books and I've heard him talk and all that stuff. And I think it's great. But the easiest way, in my opinion, of reading all this stuff and everything to become a millionaire is to just write books about how to become a millionaire, right? So it's kind of like the Warren Buffett effect. Everything he says, we take so profoundly because he's been successful and he's like known. But it is this new age of all this technology we have with AI and stuff. I am shocked that Warren Buffett is just now stepping down, right?
I am. Yep.
It's like, it seems like he should have. I mean, I love the guy. He's brilliant, all that stuff, but seems like he's been around for 100 years.
Oh, they drove him around. They had their shareholder meeting last week, and he was riding around on a golf cart, meeting everybody.
Yeah.
And
he's lived a good life.
he's lived a great life.
Oh, he has.
Yeah.
He's a good guy too. Omaha loves him.
The whole city of Omaha.
He's done good.
So this is a mind-blowing statistic. I was talking to Isaac about it the other day. Meb Faber, he's the co-founder, chief investment officer of Cambria Investment Management. Okay. So huge firm.
Yeah.
He put this out there just as a reminder, and I think I've seen this before, but it's been a while if I haven't, because it hit me like it was the first time.
Yeah.
So he said from 1965 to today, Berkshire stock could drop 99% and it would still be outperforming the S&P 500.
That's unreal.
Isn't that
How does that even make sense?
It's so
My
hard.
gosh.
Yeah.
Do
to
you have a
visualize
percentage of
that.
what it's up like over that time frame?
Y chart. I couldn't get Y charts to go back that far.
I mean,
Hold
it's
on, let me see if I can pull
astronomical
it up.
if it's that.
It's Y charts will go back. Let me see what it does. It goes
Unreal.
back to
So Berkshire B is up since 1965, 5.5 million %,
Oh my gosh.
yeah
which is
yeah a lot.
a compound annualized growth rate of 19.9%.
That's unreal.
And
Yeah.
the S&P is.
But so
10.
just wrap your.
That's
That's a great.
unbelievable.
That's a great stat to leave with. From 65 to today, Berkshire could drop 99% and still be outperforming. The
All right, so for the record, anything I said negative about Warren, I take back. I didn't really say anything negative.
That's
Unbelievable. That's like hard to imagine.
Yeah,
Yeah.
it is hard to wrap your mind around.
Yeah, it's
so,
hard. That's pretty amazing.
but yeah, he's been a legend. Still is a legend.
Yeah.
Hopefully, he's around for many more years
Hopefully
to come.
so.
But
Yeah.
he won't be leading the charge at Berkshire anymore.
I imagine that he's had capable hands doing that for him for a long time.
Surely.
I'm assuming he's not. That void is not going to be. It's kind of like Elon Musk to Tesla.
Yeah.
They've priced Tesla down because he went to do Doge. Well, there's a lot of reasons, but it's like he's not building the cars, right? I mean,
Right.
anyway, it's
And he wouldn't give up the reins if he wasn't fully confident in someone else.
exactly. I agree with that. Yeah, and it's taken him 80 years to feel fully confident with somebody
Yeah,
else.
it's been a diligent hunt.
Yeah.
60 years at least. Yeah.
Well, good conversation, fun conversation. As always, we appreciate you guys joining us, watching. Give us a like, subscribe, send us your feedback and comments and questions. We love you guys. Appreciate you watching us, and we'll see you next week.
See you next week.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.